Joining us now to share his commentary on the day's market performance is Sam Houlie from Differential Capital. Sam, thanks so much for your time this afternoon. Now let's get things started with your reading of markets this week. On Friday, President Trump, he was back at it, threatening to slap China with tariffs with 100%. But as mentioned, overnight, he somewhat dialed back on those threats, saying that things will all be fine. Basically, we're back at that taco trade state, right? Just talk to me about what you've made of market reaction, looking at U.S. futures, kind of taking in the dialed back comments in the green, European markets also in the green. But when you look at what's playing out in Asia, those stocks are in the red.
Yes, I think we've become accustomed to these type of things. I have to say that the expectation on Friday was that we'd have another one of those Black Mondays. So, the 87 crash and Black Monday was a really difficult day. That was the expectation, and that was the same for me and our team. And of course, everybody saw that tweet or the message on late yesterday. And all of a sudden, the world is back to normal again. So we become accustomed to this. My feeling is that it's really dampened things nicely for a while. I don't think there's a volatility spike.
Yeah,
we saw that on Friday, and we have to just take it one day at a time. You never really know what happens today, but for the moment, we almost back to an even keel. The big issue being the U.S. government shutdown and the impact of that, and a few other things. But really, I think the tariffs and China and the U.S. back to the negotiating table.
So those tariff conversations back in the background. What will be in focus this week is U.S. earnings season. Banks under the spotlight. What will you be looking out for when it comes to those earnings, Sam? I was looking at some analyst commentary, and it seems like expectations are upbeat, with many big institutions expecting, record-breaking revenue, market-topping earnings as well?
Yes, in fact, contrary to the headlines which seem to say that things are negative on the ground, the truth is the American companies, as for most of them, in fact, have high growth expectations, and they're likely to actually exceed those. Now, remember, what happened is that they managed expectations really well, so they dropped them a little bit. But we are looking through the earnings now, and across the board, if you look at consensus, earnings are up, and they're not only up strongly, up in decently. I mean, in some cases they're very strong, including the big mega cap stocks, which most people think are very expensive. Their earnings expectations are very high, and they're probably going to meet those. So you have to be very careful about the U.S. market. Growth will be strong.
And you've confirmed my conspiracy theory here. I've always said I think that analysts are just lowering their expectations, and this is why we're always seeing these market-topping results coming through.
Yes, exactly. So the companies have really guided really well, so you almost can see it. I mean, if you saw the graph, if you go back 5 or 6 months, in May, most of the expectations had dropped significantly, which came from, at that point, we were in the heart of the initial tariff, tug of war. And after that reset, earnings are going up, and so yes, they've all, done really well. So there we are.
All right, let's look at what's playing out here at home. Boxer out with results. Like-for-like sales growth coming in strong, up 5.3%. But we aren't seeing that being fully translated into the bottom line, as the company, of course, continues to deal with costs associated with new issued shares on the back of its listing. But let's talk operational performance. What did you make of that?
This is a strong result. It's what we've expected from Boxer across the board. I look at the trading profit, I look at the margin, and some of the margin, in fact, actually includes cost relating to the fact that Boxer is now a listed company versus where they were before. So all else being equal, to keep the trading margin flat at just at 4.1 is in fact a very good result at a time when the company is investing in expanding stores. Of course, we're seeing an even greater expansion. But if you look at it, they've gone from net debt to net cash. So there's a strong balance sheet. So all around, just operationally and trading wise, Boxer is executing phenomenally well in terms of the promise that they made at the IPO. This is probably the best non-discretionary spend retailer in South Africa in terms of like-for-like growth and growth trajectory. It's a phenomenal business, well run. Yes, so incredible result.
And it's also interesting to see how well they've been faring even in a low selling inflation environment.
Precisely. So, you know, you always look at what the inflation was and versus where the like-for-like growth was, and they're always above. I mean, that's Boxer's history.
Yeah.
Very good operators on the ground. I mean, if you talk at operators, you talk to people who develop real estate as they grow. All across the board, you know, the 360 view of Boxer is that this is a high-growth business managed very well. Of course, you are buying a share, and you know the weighted average number of shares is much higher because of the IPO. But I think that will play itself out over the next year or so. So I don't think it's an issue the market is unaware of. The truth is, if you look at across South Africa and you want to buy a food retailer or a non-discretionary retailer, Boxer is the one to buy.
And now to a company that's not faring as well, Calgro M3 taking a hit this afternoon. The last time I checked, that share price is down 5%. This comes after it reported double-digit earnings declines. Why are markets so disappointed, Sam, considering that Calgro has also mentioned that the pressure on the top and bottom line are really short-term?
It is, yes. I mean, that particular space where Calgro plays is very difficult. You know, you're being squeezed from both sides, and there is a high level of execution risk. So it's interesting the way the market works is that if there are any execution risks, what they're really looking to see is whether you can come out of it.
Yeah.
And once you come out of it and you've proven that you've come out of it, the market typically rewards you post that. I mean, we've seen it for a lot of stocks. There's a whole cohort of stocks where the market is waiting. You know, they're suspending their belief. That's what they are. You know, they're saying deliver, and once you deliver, we'll be happy to reward you. And I think that's what's happening with Calgro. I mean, I think they've done really well in terms of their NAV. And the message to management is just keep doing what you're doing. In time, you will be rewarded.
All right, let's hit pause on the conversation. Before we move on to your stock pick, let's take a moment to touch on which counters your industry peers are watching closely.
I like Bidvest. So when the market is rallying and it's commodities and everything, one of the things that you also should look at is the stocks that have lagged. So Bidvest, great quality company. I think the market sold it off because they've made quite a few acquisitions over the past 3 years. They're highly indebted right now. But they've said, we've made these acquisitions. It means we've created a big international business. Over the next 3 years, we're going to pay down our debt. We're going to consolidate this business, and we're going to have the world's biggest hygiene business. It's trading at like a 20 or 30% discount to its long-term average. This is a business that has a reputation for generating cash, not spending too much on capex relative to turnover, and being very shareholder friendly. So I think at current valuations, you have very limited downside risks. It may take a little bit longer than I think for profitability to come through, but I think the patient investor will get rewarded there with increasing returns over the next 18, 24, 36 months.
Picking FirstRand, it is one of the quality South African players of the big four banks, the highest return on equity, at least of the big four ex-Capitec. And it remains very well positioned for improvement in economic conditions in South Africa. It's got a very strong franchise. The share has lagged somewhat, partly because of this UK motor conditions commission scandal and the remediation fine that they're going to have to pay. I think they've largely provisioned for that. I think the quantum sort of is quantified. I mean, might be slightly bigger than their provision ultimately, but that overhang is going to move away from the share price. And as we see improving economic conditions in South Africa, the banks are going to continue to do well. The valuations will start to pick up, and I think it's a solid bet for a recovery in South African equities off the back of improving South African conditions.
So Roy and Rowan picking locally listed counters, Bidvest and FirstRand. Your analysis on those counters, Sam?
A few thoughts. The first is laggards are always interesting because you have to look at them. You know, the feeling and assumption would be that because they've lagged, you know, that there will be some recovery.
Yes.
But it's not always the case. These things can take a lot longer. So in the case of Bidvest, we're very cautious. Our feeling is that precisely the way it's been described is that if you can find a stock that has no debt, has no execution risk, is focused on South Africa at a lower valuation, where the company's on the other side of the difficulty, you know, they've already come through it, then you are much better allocating to that. So we can find many other stocks that are, in our minds, have a better risk-reward profile than Bidvest. We like FirstRand and we like all the South African banks, so I would agree with that.
All right, and what else do you like? What are you hanging your hat on this afternoon? Your stock pick?
Before I go into the stock pick, I'll just say that I like South African banks and I like South African discretionary retailers, especially the apparel retailers. Our feeling is that the data on discretionary consumer spend is picking up. Now, it's not flying, but it's better than what it was. And all that you need to have a re-rating in the shares is an increase. The stock is Pick n Pay. It's a stock I've mentioned here before. It's not quite exactly a discretionary retailer. Yeah. But having just looked at the Boxer results, the market cap of Pick n Pay is 22 billion. That's the price you pay for their Boxer stake. And they both have recently either given trading updates or had results. And Pick n Pay is improving significantly with like-for-like sales going in the right direction. And we feel that that increase, which has been happening for a while in terms of consumer spending, will work its way through. So Pick n Pay continues to be a pick that we like, along with other South African retailers or banks that we think can benefit from this increase in consumer spend. That's on its way. It's already happening. All
right, let's leave it there. Sam, thanks so much for your time and sharing your insights with us this afternoon. That was Sam Houlie from Differential Capital.